Hello everyone, welcome back to my YouTube channel. Today's video is very important for everybody who want to understand that how banks calculate the ECL under IFRS 9. And today's session is going to be a practical session because we can implement all this concept using Python or SAS. And I can teach you also, but the thing is the focus for today is going to be on the calculation because that is something everybody wondering, right? That how actually the calculation is happening on the back end and what are the guidelines by the model. So behind every loan approved by the bank, there is an entire risk engine which is working at the back end. Okay, so the probability of default, expected loss, then recovery amount, customer risk stages, even future recession impact, all those things are calculated. So in this entire framework, this is called IFRS 9 expected credit loss framework. In today's video, what I will be covering, so let me be very honest on that also, how bank actually calculate ECL. That is the ultimate goal. We will calculate probability of default, LGD and EAD. Three things. And then how stage wise, because IFRS 9 is a staging based model, stage 1, 2, 3, how they work. So we'll calculate that also, and how the real workflow inside the bank is going on. We'll talk about that. Now, without wasting any time, let's move forward. So all of you can see one of the data which I already prepared, okay, because we are going to do some calculation on this. Before going to that example, let me be very clear. What is ECL? ECL means expected credit loss. So it is basically what? How much loss a bank expect in future after a borrower who can default. So that is known as ECL. Earlier, bank used to recognize losses after default is happening, but under IFRS 9, bank must estimate future losses well in advance. That's the whole goal. So that means even if the customer is not defaulting yet, bank still creates provision based on the expected future scenario, considering 2008 crisis. Now there is a main formula to calculate ECL. So what is the main formula? So main formula of ECL is PD multiplied by LGD multiplied by EAD. All of these three components are very important. So PD stands for, as I said, probability of default, LGD is loss given by the default, and EAD is exposure at default. All these three concepts are very important. Without understanding these concepts, you will not be able to actually go forward because this is a stage 1 in terms of understanding the concept. Now let's take this example where you can see so many things. Loan type is there. So all these are variables, right? In a data, I'm just taking the example of one customer, but you can have like 10 or 20 million and whatever number of customer. So let's talk about the important variables. So I have taken the field as columns. So loan type, then we have origination loan amount, the original loan amount which is taken, then current outstanding, then customer DPD. DPD stands for day past due. Then the credit score of the customer, monthly income of the customer, what is the EMI the customer is paying, then collateral, what is the collateral he has given, if there is any or none. So then we talk about the expected recovery because every month he's paying the EMI, so there is a recovery happening, and in the last we have like future expected utilization by the customer. Now let's talk about the first and foremost concept out of three, that is probability of default. So as the name indicate, what are the probability that a customer will default as known as probability of default. Now that is the simple logic. Now let's talk about what is a formula. So PD always equals to number of default divided by total customer. So we'll calculate number of default customer, like who have already defaulted, divided by total customer. Now, what is default? Some of you can wonder that. So any customer who's not paying EMI for 3 consecutive months and basically not paying EMI for continuously 90 days, they miss 3 EMI. So that customer generally consider as a default customer in the banking term. So now let's go back to the formula. So this is the formula for probability of default. So there are some inputs which you should know for all these three things. Like for PD there are different input, LGD and EAD there are different input. When I say input, I mean there are different columns which are required. Now when you are calculating the probability of default, the important column are like credit score. Credit score usually you get from the bureaus. The bureau like Equifax, Experian and all of them. Then you get the DPD buckets, the day past due. That is something bank internally can also calculate. Then you check the income. What was the income of the customer? This is very important. Then we check what is the EMI. Okay, so again, this is financial data. Then we check the utilization percentage of the customer. Like how much loan he has taken and what is the utilization percentage out of that loan. Then we check the delinquency history. Like in past also, if the customer has been delinquent in any other product, let's say credit card he has taken, but he was not paying the amount on time, something like that. So we check that. Then we check the loan tenure. This is again very important. What is the tenure of the loan? What is the income? All of them are associated. So calculating PD is not easy. Okay. Then you need next is existing loan. If the customer have any existing loan, we check that also. If any existing loan on the name of the customer do exist, then we check the age. Age is very important factor because age tells that how much job is still he would be doing, how much his overall career left. Then we check the employment type. Because if a customer is government employee, so obviously in India, you will be working till your last breath. So that's something considered because private sector is not that much stable compared to the government sector. So that's why the bank need the employment type and also. Then we check the macroeconomic variable. Macroeconomic variable are very different for all the countries, all the areas, because this is so much dependent on the world overall. Because let's say COVID happened, right? So after COVID, nobody could predicted that something like that can happen again or not, right? So this is a very subjective thing. That's why macroeconomic factors are very versatile in nature. Now, these are the very useful columns. You should remember all the name of these columns. Now, how do you calculate? Okay. So we'll talk about that now. That when you are doing the calculation of PD, how you'll do that. So suppose bank studied the historical data, okay, like they have already done some research on their historical data. They have done research on, let's say, some 10,000 customers from the past. Okay. Now, out of those 10,000 customers from, let's say, 2025, last year data, out of 10,000, 200 defaulted. Like 200 customers were not paying EMI consecutively for 3 months back to back. Now, there are 2% of default happened last year. Now, how you'll calculate PD? So I gave you a formula, right? How you'll calculate? So this will be 200 then divided by 10,000. If you convert it into probability, that is percentage, so that is coming 2%. Out of every 100 similar customer, bank expect around 2 customer will default out of 100. Out of 10,000, it's like 200. So this is something consider within 12 months. Okay. So because IFRS 9 works like that. So what I'm trying to make you understand, out of every 100 similar customer, bank is expecting 2 customer will default within the next 12 months, because stage 1 talks about the 12-month concept in IFRS 9. So you just understand that. I hope this is a fairly easy concept, right? So that's how we calculate the probability of default. There is no very hard and fast calculation which is happening, some big formula, nothing like that. Just understand the concept, then you'll understand everything. Okay. Let's talk about now the second part, that is LGD. That is your loss given by the default. So for LGD, you have a simple formula: exposure at risk, like how much loan you have given, minus the recovery. Recovery means how much loan the customer have already repaid. So from the total exposure, we'll remove the recovery and then divide it by exposure, whatever the pending exposure. So this is the equation to calculate your LGD. Okay. Now when we talk about LGD, so what are the inputs for LGD? Just the way I told you for PD, because understanding the input itself is the most important. To estimate LGD, bank use recovery related information, because this is more about the loss which will come because of the non-recovery, right? So the bank will mainly focus on certain variable like outstanding amount, like how much amount is still need to be paid, like how much amount customer will pay in future. Then recovery amount, how much already have been recovered. Then collateral value. What is collateral value? For example, I took a loan for car. Okay. So now what is the worth of my car? So bank can obviously sell my car if I'm not paying the loan, right? So that is the value of your collateral. They check that time to time. Then recovery time. How much time for recovery is still will be there. Okay. Then they'll check collateral efficiency. Okay. Then they'll check like legal recovery history of the customer. Legal recovery. If there is any legal recovery history of the customer do exist, all of these are columns, guys. So you just remember all these, right? Then we'll check the write-off. Write-off is a concept, very important concept. Once bank is sure that the customer is not able to pay the money, bank put that into their write-off. That this is something we have to forget. Then they check the recovery cost. If the customer is not paying something, so how much bank need to invest to recover the loan, like in the legal cost, in the transportation, and you might have heard the recovery agent from Bajaj Finance is going to somebody's house. So there is some petrol they are spending, so many hidden charges. Those are operational costs. So those are also part of this. So that's why you should know that. Now, how bank derive LGD? Okay. So in this example, let me Let me just directly pull this itself. Let's go. Yep. So how do you calculate LGD? So in LGD, you can see what is the exposure amount. Your exposure is 8 lakh rupees. Okay. Now the second thing is recovery. What is recovery? You can see recovery is 4,80,000. This is your recovery. So what is the formula? Okay. So for LGD, let me clean this up a little bit. So now how we will calculate the LGD? I just told you the formula, right? So LGD will be equal to this 8 lakh minus 4.8 lakh divided by 8 lakh. Okay. So 8 lakh minus 4.8 will be close to 3.2 lakh and divided by 8 lakh. So if we divide 3.2 by 8 lakh and we convert that into like percentages, so it will close to 40%. So basically loss given by this default will be 40% of the value. Even after collection and recovery effort, bank is expecting that 40% of the loss will happen. So that's why the concept of LGD is important. Now the bank know that what will be the loss given by the default. Now let's talk about the next concept, that is the concept of exposure at default, which is your EAD value. So when you calculate the EAD, okay, so EAD also have a formula. EAD have a formula just like the other two. So EAD equals to current outstanding amount plus, so current outstanding, how much still the customer need to pay, plus expected future utilization. Expected future utilization. Okay. Now there are some inputs required for EAD also. So to estimate EAD, bank use utilization related information. So they check current outstanding balance. How much the customer still need to pay. They'll check credit card limit of the customer. Okay. Then they check the future utilization trend. Then they check loan schedule and then they check prepayment behavior. This is very important. Prepayment behavior. So now when we talk about the overall EAD concept, so just suppose now in front of your eyes itself, you can see what is the outstanding amount, that is your 8 lakh, and what is the future utilization, just look at the bottom, that is 1 lakh. So simply 8 lakh plus 1 lakh, so your EAD value will be equal to 9 lakh. So now you have calculated all the three matrices, right? So about EAD, one more thing very important, bank estimate exposure may become 9 lakh even before the default. That's what it means, right? Now IFRS 9 works as per the staging concept. Okay. So there are so many stages, as I said, 3 stages. So now in IFRS 9, we have 3 stages. So let's talk about all the 3 stages. Okay. So the concept starts for stages. So you have stage 1, stage 2, stage 3. Stage 1 is your normal customer. Okay. Which are not either delinquent or defaulted, they are normal customer. Then stage 2, only those customer will move to stage 2 which have a significant increase in the risk. Let's say they went to DPD 30. They have missed 1 or maximum 2 EMI, but they have not defaulted. And stage 3 is only for those customers who has defaulted, which are like DPD 90 plus. So that is a standard definition in most of the bank, that if a customer is not paying 3 consecutive EMI, that customer is considered as a default customer. Now in stage 1, how you'll calculate the value for ECL. So for normal customer, now you can take the assumption, right, that a customer is not having any bad characteristics or is a proper customer. So very low DPD, there is no past due, then have a good score, and then there is a stable repayment of that customer. So simple 12-month ECL is very easy to calculate. What you'll do, we calculated the value of PD, LGD and EAD. You remember that, right? So now what was the value of PD? 2% in generic when we took the past trend. Then 40% was the LGD. Then we'll multiply it with what? 9 lakh. So this is your ECL for the stage 1. Now when you calculate the value of this somewhere comes to, you do the calculation. 7200. So because customer is healthy, bank create small provision. So this is the expected credit loss which the customer can give the bank. So bank will make sure that this much of the money they are keeping in their pocket to absorb the shock if the customer is defaulting. This is stage 1. This is your stage 1. Now we talk about stage 2. So in stage 2, the condition changes, right? So the conditions are 30 plus DPD, the score deterioration has happened and highly utilization has increased. Now IFRS 9 use lifetime PD calculation. So this was the assumption based PD which we calculated. So now for calculating the stage 2 PD, okay, how do you calculate PD changes? History risky customer data. You check in the history in like 2025, what was the history, how many total default happened, like total number of default. So similar customer base was there, for example 10,000 which we discussed, okay, and default were like close to 500. So now you have a PD of 5%. How? Like 500 divided by 10,000 which will come to close to 5%. So now we'll calculate the ECL for stage 2. All these calculations are done in either SAS or Python usually in the bank, so that you will see. Now you understand the lifetime default of the past was close to 5%. So now this 2% will be replaced by 5%, multiply by LGD will be same 40%, multiply by exposure which is 9 lakh. So the value will come in this case will be different and the exposure will be higher. So the value will somewhere close to come as 18,000. Now the bank need to keep a bigger provision. So you can notice how provision increase sharply when the customer riskiness is increasing over a period of time. That's what the main goal of IFRS 9. That's where this model help the bank to calculate all these values so that the bank can keep that cushion if something happens, something bad happens. Now let's talk about stage 3. In stage 3, condition will again change. The customer has moved from 30 DPD bucket to 90 DPD bucket, right? And the customer has defaulted. Non-performing asset has been declared as NPA and bankruptcy sign has been evolving over a period of time. So you will notice all that in data. Now both PD has increased, LGD has increased because recovery becomes really difficult for the bank. Now stage 3 PD. So let me first mention this is stage 2. Stage 1, stage 2. In stage 3 PD, basically historical default customer will be again checked. Like the whole overall lifetime customer will be checked. Now out of 10,000, bank have observed that out of 10,000 non-recovery was close to 8,000. Now PD will be like huge for the defaulted customer, for not for the whole population, right? Out of 10,000, 8,000 were non-recoverable, only which were belonging to the default bucket. So that 8,000 of the non-recovery will be divided by 10,000. So now you have like 80% chances that these people will default. So let's talk about the stage 3, which is the default stage. So guys, at default stage, which is stage 3, let's say you knew that exposure is 9 lakh, which we already checked. Now there is a assumed recovery of 3,60,000 in this case, right? So there is a assumed recovery of 3,60,000. So how much the loss will be? So loss will be equal to exposure minus recovery. Simple. Now 9 lakh minus 3,60,000 will be close to 5,40,000. So this is something coming as a loss. Now LGD have a formula which is all of you know, right? So now for calculating the LGD will be loss, okay, that is 5,40,000 divided by total exposure 9 lakh. So here the calculation comes to close to 60%. So you remember like stage 2 PD only changed. In stage 3 you have changed LGD, right? LGD also changed, PD also changed, both the value has changed. The PD for this will be calculated on the basis of what? There was total assumption of 8,000 customer non-recoverable out of 10,000 who were defaulted, and this is all trend on the basis of history. This is not the total customer base, okay? This is the defaulted customer base, like stage 3 customer base, okay? So that's why we are calculating the value as 8,000 out of 10,000 and the PD value is coming to 80%. Now the ECL for stage 3 will be what? 80% multiply by 60% LGD multiply by 9 lakh, okay? And the value of ECL will come close to 4,32,000 here. So this is your ECL for stage 3 defaulted customer. Now you can understand that the value has significantly changed for all these stages. Stage 1, stage 2, stage 3 ECL was like 7,200 for stage 1. Then stage 2 it was 18,000. Stage 3, like a customer who has been coming to stage 3, the ECL has been increased like significantly 4,32,000 as a estimated credit loss, not the real loss, estimated. Okay, again, this is important for all of you to understand that this is something estimated value. Now, something important. This is why bank monitor stage migration very closely, okay, from stage 1 to stage 2, stage 2 to stage 3, because this can massively increase provisions and bank need to keep that much buffer in their pocket, directly impacting bank profitability, also the image of the bank in terms of any financial crisis. Okay, so now let me quickly repeat certain things so you understand. So there is a workflow. So this is all the calculation we have done. So now what are the steps we have followed? Step 1 was the extracting customer from the database using SQL, SAS or Python. Stage 2 was the segmentation of the customer. Stage 3 running the PD. Stage 4 calculating LGD. Stage 5 calculating EAD. Now we have 3 components. Stage 3 is identify which stage we are at in IFRS 9. Then we are calculating the ECL on the basis of the stage. And the final is generate finance and regulatory report and send it to the finance team or the regulator so that they can do an audit on your bank and help your bank. Okay. Now, if you understood this video, you now know practically that how IFRS 9 is calculating all these things. And remember, these calculations happen for million customer within a month inside the bank, not just for one. This was just for one customer, guys. That's why we need programming language, right? If you do this all for million of customer, you cannot do that manually or using Excel and all. Okay. Now, SAS is widely used, SQL, Python, risk model, you should know. Then you should know the IFRS 9 engine guideline. That's what I have told you here. So if you want a part 2 of this video, I can definitely make that. And if you like this video, please share this video with your friends, your colleagues, whoever learning all these concepts. And if you like my effort, please subscribe to my YouTube channel. Thank you so much. Put your questions in the comment section. I reply to all the comments. Thank you so much.